Get in a perspective as to what is the outlook on the risk-on rally that's playing out globally, the central bank's stance on handling growth issues, and where India stands vis-a-vis the emerging markets. Very special guest joining in our studios right now. We have Conkey. He's the president and CEO, Manulife Investment Management. And recently as well, you've closed the $1.5 billion private equity fund. We'll talk about that and lots more. But at a time when the global situation is on tenterhooks to a certain extent with what's emanating from the US, China, Iran, how are you looking at the global scenario?
Well, we're looking at the global scenario as one in which it's improving moving into 2020. As we came into 2019, the significant risks that were there in terms of earnings challenges, in terms of just unknowing how the China-US trade issue would play out, a lot of that is beginning to be rectified. There's still a lot unclear, but a lot of that has been changed. And another key part has been a change in U.S. Fed approach towards monetary policy. And so we think a lot of the risk elements are beginning to recede, which is a positive for growth and probably in the second half of 20.
Whichever way I look at the U.S. economy, every important economic indicator is at its peak. U.S. GDP to financial markets, U.S. corporate earning graph, U.S. unemployment rate, all-time low. I've been told that this is the biggest economic expansion the U.S. economy has ever witnessed. My problem or my challenge is that when the news is good, then what happens? Aren't markets pricing in all the good news? Like they say, markets climb the wall of worry and they always come down on ray of hope.
Yeah, it's a fair observation. And I think there's a lot of credibility to that. The piece that makes it all work, this is different from prior economic cycles, is your monetary transmission system intact? That really comes down to liquidity, to leverage, and capital in the banking system particularly. And we feel that the lessons that were learned coming out of the 2008 global financial crisis, the U.S. system in particular is very well positioned for that. And in many ways, banks around the world are in a much better position, as are securities houses, et cetera. So clearly, you could look at it and say we've borrowed some growth from the future into 2019, and that's been reflected in financial assets. But at the same time, we think that we're moving into an environment where monetary policy in particular is going to be relatively stable, we think, for a few years. And so given that underpinning, we feel okay about growth, particularly in the second half. There's still uncertainties, as I mentioned, but we feel it's all right at this point.
You know, Buffett once says that, excuse me, interest rates, they work like gravity. Interest rates, they go higher. Markets will come down. Last 10 years, what we've seen is loose monetary policy, interest rates coming down, and a big bull run in equities. It's not just US equities, even in emerging market equities.
Right.
If one works with an assumption that interest rates cannot go lower, and in somewhere in the next 5 years, they will go higher, what happens to this good old thesis that rates go higher, markets come down?
It depends. I just gave you that answer, but it depends on why rates move higher. If rates move higher because of solid underlying growth and that developed economies are able to create a level of inflation that's needed, frankly, around 2%, then that's okay. There obviously would be cyclical corrections in risk assets, notably equities. But it depends. So I think the bigger issue is not about rates rising, but in fact, once again, can you start to stimulate some form of wage-driven inflation that could be carried over towards benefiting all investors and all people in an economy? Because that's the big issue right now is inflation's too low.
What's the view on India then? Because we are in sort of a, bipolar state, if you could call it that. The equity market valuation is telling you something else, but the economic reality on ground with regards to be it interest rates, be it the inflation threat, and now more so with the crude spike up, and you don't know how this entire situation between US and Iran is going to play out and what it's going to do to crude and thereby our inflation. And growth is up 5% for the first time in many, many years.
Yeah. So growth is a nice snapshot of today. And equity valuations are discounting what investors are seeing and what companies are seeing over the next 5, 10, 20 years. And so we believe is the gap. And so inside of that is what's behind that? What's behind investor expectations? And what's behind investor expectations is a confidence in the government policies in terms of privatization, in terms of rebuilding capital through tax cuts, and then through promoting capital investment through targeted tax policies is there. So when we look at that and we look at future earnings growth relative to today's challenged growth environment, we think that there's opportunity in that. It has been reflected in the valuations on the India weight inside the emerging market indexes, and it's slightly below where it has been historically. So I think it's captured there, but we're confident in the longer run.
So as of now, just to give us a better perspective, I know you outlined the overall macro situation. In terms of the fund flows, how are you looking at that? How are foreigners as of now looking at India versus our emerging market peers?
Great question. So I can speak to how our investors are viewing India. And so we invest in India through our multi-asset asset allocation vehicles. We have global emerging market, both equity and debt vehicles. And then we also have pure India equity strategies. And right now we're relatively neutral to index weights as a weighting in India. We do look at things from a bottom-up perspective. And so so we're engaged. We're not overweight at this point. There are some challenges in terms of execution, but in the longer run, we think that the most likely place for us would be to increase that as the execution happens. Obviously, there's some challenges on the fiscal side and the rate of speed of privatization. So I'm going to see that play through.
Last 10 years, emerging markets have underperformed US, which is developed markets. Emerging market currencies have underperformed. And dollar really has been the linchpin of where the money movement has been. Will that change? Because in the financial markets, you know this better than anyone else, that there is something called a mean reversion and cycle.
Sure.
This decade, or the decade gone by belonged to America. Before that, it was China and India. Will it come back to some other place now?
Well, I think that it's likely. We do expect in the longer run. If we look at, I mentioned earlier our multi-asset strategies, and we look at both the shorter term, 6 to 12 month, and also a 3 to 5 year horizon. In the shorter run, we think that developed market economies and currencies outperformed emerging markets. But over 3 to 5 years, our allocation views are that both emerging market equities and emerging market currencies will outperform the U.S. The driver is going to be the effectiveness of transitioning from monetary policy driving growth and driving investor behavior to that of more fiscal policy, which can really drive some of the behaviors that are really needed to move economies forward. And in fact, that's what we think is the biggest transition as we move from the 10s, so to speak, into the 20s, is the transition from monetary policy to fiscal policy. And so the goal would be to see that emerging market countries continue the reforms and building of infrastructure and investment-friendly environments that can create that.
Chris, where do you stand in this entire active versus passive debate, investing debate?
We were talking about that a little bit earlier, and so we believe that in the long run, that active management creates a better risk return profile than does passive. So the key there is to be able to leverage active, fundamental, proprietary work and portfolio construction to really manage tail risk. And so to us, that's the most important element. A lot of markets, in some cases, passive may be more appropriate, where it's highly efficient, highly liquid, highly concentrated. But when you start to move away from some of these markets, we think that there's significant opportunity for active.
Chris,
Yeah, sorry.
please.
No, I just wanted to know, if this were to be applied to India, would it stand true? Because what you're seeing in India is a selective bunch of stocks are the ones which are taking the benchmark index higher, which has given you a return, a stable return of about 13% in 2019. But the large part of the market, your mid, your small caps, the entire broad universe has underperformed for the last 2 years.
Well, I think it's underperformed for good reasons, given some of the cyclical pressures, financing, a lot of other things. When you have and this is going to sound awful, but when you have indiscriminate buyers and sellers that come into a market without truly understanding the market and having feet on the ground and have as an edge your competitive research component, then what's going to happen is that markets are driven at the top by, say, foreign flows are only by the largest, most liquid names. That they're not committed, they're not, once again, having on-the-ground research capabilities. So it's almost like a beta exposure as opposed to the ability to drive alpha. And
so what are you better off investing, actively or passively, when it comes to India right now?
Oh, I would say actively. I think that there's such a dispersion of valuations. I think there's such a dispersion, particularly when you start to move down cap, that there's a significant opportunity. It's a less efficient market. And that's where I think true active, really high quality research, proprietary research driven work can
Chris,
really stand out.
I'm yet to meet any money manager who's giving me a scenario where things could go bad. Every time when we meet sell-side experts and buy-side experts, they always tell me, last year was bad, this year will be better. Last year was terrible, this year will be better. No one's come and told
And the
me,
underperformers will perform, which exactly what you said.
Please pardon me, but I'll hope you appreciate where I'm coming from.
Sure.
Nobody tells me that, okay, we've had a good decade behind us, guys, what? This decade is going to be bad.
So there are a few. That's a great question. And
at least money managers don't
risks.
tell me this.
There are risks. I mean, one view, and this is a discussion we've been having internally, when one looks at long-term growth rates and looks at multiples and valuations, one could make the argument that in 2019 that you borrowed returns from future years into that time frame, and there's validity to that. I mean, the question came up earlier about valuations, are they sustainable, and is that simply, you don't have to have that corrected by a reduction in valuations. You can grow your way into it through earnings. So in other words, your returns will be less. So that's clearly a risk in terms of people looking out the back window, projecting returns going forward, and that's not sustainable. The other piece is while the phase one talks are underway between U.S. and China, that problem's not going away. I mean, this is a long-term challenge, and much like U.S.-Iran, that is just another geopolitical risk that's added. And so I think that it has potential to come back and have an impact on investors. The other challenge that really comes into play is terms of investors taking on risks to hit income needs as economies and populations age. And typically that doesn't end well. So managing risk within that is critically important. But aside from the systemic nature, we feel reasonably confident over the course of the next 24 months or so.
I was looking for that answer. All right, appreciate your time. Lovely meeting you.
Thank you so much.